Here are 10 tips for avoiding an income tax audit. Number 1, be neat, thorough, and exact. If you submit a paper return, make sure that it looks professional. This will help you avoid unwanted attention. Make sure your math is correct and everything is neat and clean. Also, avoid round numbers like $100 or 500 miles, as this makes it look like you're guesstimating instead of taking numbers from accurate records. Be sure to include all necessary forms and make sure that your state return is consistent with your federal return. The second tip for avoiding your income tax audit is mail your return by certified mail or use a delivery service. By doing this, you'll have proof that they have received your return even if it somehow gets replaced after the fact. Number 3, do not file early. Unless you're expecting a large return, you shouldn't file your taxes much in advance of the due date. The IRS generally has 3 years to decide whether or not to audit your return. Filing early just gives them extra time. Number 4, don't file electronically. Given the expense of data entry, the book claims that the IRS only has about 40% of the data on paper returns transcribed. The paper returns are then warehoused for 6 years before being destroyed. Because audit decisions are made based on the transcribed data, filing a physical return supposedly reduces the odds of an audit. Number 5, form a business entity. Audit rate statistics show that partnerships and small corporations are audited far less often than sole proprietors. Number 6, explain items that the IRS may question. If your return contains items that you think might raise eyebrows, include an explanation and documentation. Number 7, avoid ambiguous or general expenses. Don't list expenses under headings such as miscellaneous or general expenses. Number 8, report all of your income. The IRS is convinced that many self-employed individuals fail to report all of their income. Number 9, watch your income to deduction ratio. According to a statistics professor named Amir Axel, who got audited back in the 1990s, the key factor leading to an audit is the ratio of your expenses to your income. Apparently, his audit was so unpleasant that he did a statistical survey of over 1,200 tax returns and then wrote a book about it. So if your business expenses amount to less than 52% of your gross business income, you are not very likely to get audited. If your expenses fall in the 52 to 63% range, there is a relatively high probability of an audit. Number 10, beware of abnormally large deductions. If you have any other questions, consult your CPA.